Over the past few years, I've tried many different option trading methods: credit spreads, debit spreads, calendar spreads, iron condors, iron butterflies, naked calls, strangles, straddles. But for me, the absolute best performing option trading method is the option wheel strategy. And why do I say this? It's because I grew my $30,000 account into $100K in just 1 year. So this is my guide to the best option wheel strategy. So in this video, I'm going to be talking about the wheel strategy. And let me start off by saying I didn't invent the wheel strategy. I don't know who did, but I do use it for a lot of my trades, probably 70%, maybe closer to 80% of my trades. So let me start by saying that the wheel strategy, basically it's a process that combines two different option trading methods. Now, the first one is selling a cash secured put. And the second option trading method is selling a covered call. Now, it combines both of these methods together, and together they comprise what's known as the wheel strategy. Now, at this point, I need to describe and explain what a cash secured put is. So I'm going to walk you through selling a cash secured put and how it works. So on the left-hand side, you can see me. And on the right-hand side, you can see the stock market filled with buyers, or actually one buyer in particular. So on day one, I'm going to write a cash secured put option contract. And remember, so this is going to have an underlying stock. In this case, it's going to be ABC Incorporated. It'll have an expiration date. In this case, it's going to be a 1-month expiration, so 30 days out. And it's going to specify a strike price. So for our example, this cash secured put is going to have a $100 strike price. Now, in order for me to write this cash secured put option contract, I need to have enough cash on hand reserved as collateral in case the shares get assigned to me. So I'm going to have some money reserved and stored as collateral in case the shares, the ABC Incorporated, get assigned to me. At this point, I'm going to offer this option contract available on the stock market. An interested buyer is going to see it, and what they're going to do is signify that they want to purchase it, and so they're going to pay the option premium to me in exchange for the contract. And so that the transaction will take place, I'll receive the premium, and then the buyer gets their name added or associated with the cash secured put option contract that I sold to them. Now let's skip ahead and go to day 30. What happens on expiration? Well, one of two things can happen. Number one is that the market price for ABC Incorporated could be below the strike price. So in this case, the option contract would be exercised. And so my collateral, the money that I had reserved, that's going to be used to purchase 100 shares of stock. And so my collateral will go in, and I'm going to receive 100 shares of ABC Incorporated. So now I'm going to be the owner of record of those shares, and I'll get to keep the premium. Now, in the other case, the market price is going to finish above the strike price on expiration date. And so when this happens, the actual option contract, well, that expires worthless. Additionally, my collateral is returned back to me. It's released back to me. So now it actually never left my account, but it's now no longer reserved. And I get to keep the premium. So here's what I want you to notice. In both cases, I was able to keep the premium, no matter what happened with the strike price or with the contract. So that was a description of selling a cash secured put, which is part of the wheel strategy. Next, I'm going to talk about selling a covered call. So again, we start off with me on the left and the stock market with buyers on the right. Now I'm going to create a covered call option contract. I'm going to use an underlying stock, ABC Incorporated. I'm going to specify a 1-month expiration date, and I'm going to put a $100 strike price as part of this option contract. And the reason I'm able to write this covered call is because I actually own 100 shares of ABC Incorporated, the company's stock. So this allows me to use that as collateral against the option contract. Now, once I've done this, I offer it for sale on the stock market, and then an interested buyer will let me know that they want to buy my option contract, and so they're going to be willing to pay the premium for that option contract. So I receive the premium, and the buyer then takes ownership or is retained or is associated with the option contract. And now let's skip forward 30 days to the expiration date and look at what happens. It's going to be one of two things. So the first result is the market price finishes above the strike price. So in this case, the option contract is going to be exercised. And so my shares will get assigned to the buyer, and I'm going to receive payment for those shares, and I get to keep the premium. Now, the other result could be that the market price finishes below the strike price, in which case the option contract is going to expire worthless. And I'm going to retain the ownership of those shares, so I don't have to give them up. So that's something I want to point out. I keep the premium in both of these cases. So that was a description of selling a covered call, which is the other option trading method used for the wheel strategy. Now that we've gone through both option trading strategies, it's time to jump into the wheel and take a look at how its processing uses both of these trading methods. I've broken down the option wheel strategy process into 4 unique steps. I'll explain each step in detail so that by the time we're through, you'll have a thorough understanding of the option wheel strategy. Once you understand the process of the wheel strategy, you'll understand how I'm able to use it over and over again, making profits at each step along the way. For this example, we're going to use an imaginary company called ABC Incorporated that's trading on the market with a current price of $12 per share. Starting at step 1, the first thing I'm going to do is sell a cash secured put. So I'm going to create a cash secured put option contract for a company that I want to own. So in this case, for this example, I'm going to use ABC Incorporated. I'm going to set the strike price at $10 and assume the current price is $12 and an expiration date of 1 month, so 30 days out. Now, in order for me to sell this option contract, I need to have sufficient funds reserved as collateral. So in this case, since the strike price is $10, I need to have enough to purchase 100 shares. So that's $10 times the 100 shares means I need to have $1,000 reserved as collateral. Now when I submit the cash secured put option contract, an interested buyer will then pay me the option premium in order to retain the rights to the option contract. And in return for selling the option contract, I immediately receive the option premium, which is credited to my trading account, and I can use it immediately for investing in other trades, or I can withdraw it and have it sent directly to my bank account so I can use it for other purposes. Now let's move on to step number 2 of the wheel strategy. So what happens next is when the current price of ABC Incorporated dips below my strike price, which is $10, let's say for example the price drops to say $9.90, then I'm able to get the shares assigned to me. So now I'll receive and become owner of ABC Incorporated, the 100 shares, and I'm going to use the money from my collateral to pay for those shares. Now I'm going to move on to step number 3 of the wheel strategy, and this is where I'm going to be selling a covered call. Now it's because I have those 100 shares of ABC Incorporated, I can write now a covered call option contract using my shares as collateral, and I'll be setting a strike price above my cost basis so that I can guarantee a profit just from the sale of the stock through price appreciation. And I'll set an expiration date for this example of 1 month. So I write the covered call option contract and make it available, and then a buyer who thinks that the stock price will actually meet my strike price or go higher will be motivated to buy my option contract. And so what they're going to do is they're going to pay me the premium for my option contract, and in return, they'll receive the right to exercise this contract. So they get the contract rights, and I'm going to receive the premium payment from the buyer. Next, let's move on to step number 4 of the wheel strategy, and this is where my shares get sold. Now, for the purposes of this demonstration, let's make the assumption that the share price for ABC Incorporated jumps up to at least my strike price, or a little bit above. Let's say it's $15.50. What happens? The option contract is going to be exercised at that point because the terms and conditions have been met. And so the buyer now is going to pay for those shares, and I'm going to release the shares over to the buyer. So now the buyer has the shares, and I'm going to be paid $1,500 for the shares that I released. And the $1,500 comes from the $15 strike price times the 100 shares. So at the conclusion of this transaction, let's walk through what happened. So my cost basis was $1,000 for the 100 shares that I acquired through selling the cash secured put. I ended up selling those shares at $15 a piece for a total of $1,500. So the price appreciation that I realized is $500. And there's additional money that I received from the 2 premiums. One, from the cash secured put when I sold the contract, I received a premium. And the second premium I received when I sold the covered call. And so now I'm ready to start a new wheel. But this time I now have $1,500, my initial $1,000, plus the $500 I received from the price appreciation. Plus I also have the premium payments that I received as well. So at this point now, I would keep executing the wheel strategy, either for the same stock or a different stock. It would just depend on the current market conditions. And ideally, I would keep collecting premium and profits from the stock appreciation. Next, I'm going to take a little bit of time and answer some of the frequently asked questions I get about the wheel strategy. But before I do, if this information has proved helpful or you've enjoyed this video, do me a huge favor and smash that like button. So this first question is about step 2, the assignment of shares. And the question is, what happens if the current market price doesn't reach the strike price? To answer this question, let me review real quick what happened in step 1. So I ended up selling a cash secured put option contract with a $10 strike price and a 30-day expiration. So when the contract sold, the buyer paid me a premium for the rights to exercise that contract. And the only way for this option contract to get exercised is if the current price drops below the strike price. So now let's go back to the original question. What happens if the current price never drops below the strike price? Let's say that on expiration date, the current price only drops to $10.01. So it's 1 penny above the strike price. So it doesn't meet the terms and conditions of the option contract. So that contract actually expires worthless. And the trade with the buyer is closed out. The funds reserved as collateral are released back to me. And I still get to keep the option premium that I received from the buyer. And at this point, I could just start a new wheel. This next question is similar to the first one, except it has to do with the covered call. And the question is, what happens to the shares in a covered call if the current price does not reach the strike price? To answer this question, let's go back to where I actually sold the covered call. Here we see the covered call contract with a strike price of $15, and the buyer has already paid me the premium for this contract, so now they have the rights associated with this covered call contract. But now for the purposes of this demonstration, let's say we get to the expiration date 1 month later, and the current price only reaches $14.99. So it's 1 penny short of the strike price. What happens now? So the option contract expires worthless, and this transaction with the buyer is closed. Which means I still retain ownership of my shares, and I still get to keep the premium that I received from selling this option contract. And now my next step is to repeat step number 3. So I would sell another covered call contract using my same shares as collateral, and I would collect another premium payment from the next buyer of my new covered call option contract. The next frequently asked question is, can I use any stock for this wheel strategy? And the quick answer is yes, you can. In fact, any stock that offers option trading or supports options may be used in this wheel strategy. However, just a quick note, in my own personal experience, I've had the best results from stocks whose prices exhibit certain characteristics. So let me show you what I mean. Here are 3 price charts for 3 different stocks. The one on the top, you can see that the price is definitely falling. The chart in the middle shows that the price is relatively flat. And the chart on the bottom, that shows that the price is increasing. So out of these 3 choices, which one do you think is better suited for implementing the wheel strategy? Leave me a comment below with your guess. This first one, with the stock chart at the top, appears to have a pretty predictable behavior, so that might be a good thing, because it appears to have a deterministic behavior. For the chart on the bottom, it appears that the stock price is climbing higher and higher. And as a buy and hold investor, you gotta love that. And lastly, there's the chart in the middle where the stock price appears to be pretty flat. So there's not a lot of price action, and it actually turns out to be pretty boring. Hopefully you've had a chance to leave your guess for which one you think works best with the wheel strategy, but I'll go ahead and tell you which one I think based on my own personal experience. The stocks I find that work the best for the wheel strategy are the stocks that are trading flat. They're very predictable in their action and reaction to the market. And as you can see, the stock price trades within a certain range. There's a lower bound and an upper bound. Now, obviously, there's no guarantee that the stock price will continue to behave in this manner. But whenever I find a stock with a price pattern that matches this or somewhat similar, I like to zoom in on it, do some research, and find out if it's a good candidate for implementing the wheel strategy. In one of my earlier videos, I discussed why this flat trading pattern works really well for a wheel strategy. If you haven't seen that video, I'll leave a link in the description below. Which stock trading pattern did you guess? Did you guess this one? Leave me a comment below if you got it right or not. If you enjoyed this video about the wheel strategy, or maybe you got some helpful information from it, do me a favor and smash the like button. So I just shared with you the basics of the option wheel strategy. In the future, if there's enough interest, I'll be able to create a video with some other topics, including how to pick a stock for this wheel strategy, what's the best time to start the wheel, when you know it's time to close the wheel, and also how much money does it require to actually do the wheel strategy. I also have some advanced tips and tricks for executing the wheel strategy, where I can cover topics like running a multi-wheel strategy, a how-to guide for executing a cross wheel, and also how to maximize profit for each step. If you're still watching this video, I just want to say thank you so much. I really appreciate it. And to show my appreciation, I'm going to give you a bonus answer to another one of the frequently asked questions. And that question is, how much money is required to actually start a wheel? And here's the answer. You need enough money to pay for the purchase of 100 shares of the underlying stock. So if the price of the stock is $5 per share, then you calculate the cost by taking the $5 per share times 100 shares, and that end result is $500. I actually published a video showing myself option trading using a small account. In that video, I only used $250 to execute a trade, and I walk away with a 10% profit. I'll include a link in the description below. And I also want to wish you good luck and lots of success with all of your trades.